Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, March the 10th, 2026. Okay, let's look at the good old oil chart. Okay, so obviously what happened yesterday, we saw that at the open after the weekend, we had a massive, extraordinary spike up to about $120. As we all know, there was probably a couple of things which pushed the market down to a bit more of a stable situation. We had the sort of idea that the G7 would have a coordinated release from the Strategic Petroleum Reserve. The numbers being talked about are up to 400 million barrels, which would be about a third of the total reserve. That hasn't actually happened yet. Just there were some initial meetings yesterday with the finance ministers. I think the energy ministers are meeting today. So it seems as though something will happen, but nothing has been confirmed yet. Now, is that going to be substantial? I mean, it's good for the market in terms of stabilizing things, in terms of just sort of the psychology that things are sort of improving, quote unquote. But to keep that in the context, 400 million barrels would represent about 20 days of lost Middle East oil production. So 20 days of lost production. If you assume that the production has been going down for the last 3 or 4 days, it's not unlimited. So it's a positive, but at the end of the day, it's more of a band-aid kind of situation. It's not going to solve the crisis. It would sort of temporarily probably just put a bit of downward pressure on prices, but not a huge amount. So that's what's expected. There's also sort of talk about relief of sanctions. If you look at sort of global sort of supplies of oils, of sanctioned oil. So that's oil from sort of Iran, Russia, and Venezuela. There's about 2 billion barrels. So 2 billion barrels, again, about 20 days of global oil demand floating around on seaborne sort of storage. So the point is that if the US if the US administration were to sort of lighten the sanctions or even remove the sanctions temporarily, and we've already seen that with certain sanctions on Russia, that would allow some of this sort of illegal sanctioned oil to be released onto the let's call it the legal market. So, but between sort of the G7, but possible Strategic Petroleum Reserve, and also sort of the lifting of sanctions, there could be some significant amount of oil coming onto the market, at least for the short term. But of course, the big thing which caused this yesterday to come down so dramatically was there was a release from a journalist, Trump apparently saying that the war would end soon or wouldn't go on too long. Having said that, that was in the afternoon at about 3:20 p.m. But having said that, sort of in another press conference after the market had closed, Trump was a little more bellicose in the sense that he said that the war hadn't ended, that there's still more strikes going on. There's still, he was looking for total surrender. So, as always, there were sort of mixed sort of signals. And could it be that sort of earlier comment was simply, something maybe coming even from Treasury Secretary Bessent saying, "Hey, Mr. President, you need to say something to placate the markets." It's possible. So as we stand this morning, the Strait of Hormuz, as far as my research is showing me, is still not allowing for the free passage of sort of LNG or crude oil tankers or sort of jet fuel or whatever. It's still not flowing. It's essentially only Iranian-linked tankers which are flowing. So the Strait of Hormuz is still closed in a sort of a de facto way, as far as I can understand. There are still attacks ongoing from the Israelis and the Americans. So, and we also had the Iranian response a couple of hours after Trump's comments to the journalist, essentially saying, "Hey, our new leader is not surrendering. The new leader is his father's son and is quite a conservative. There's no sign of internal sort of revolt, like a popular sort of revolution or uprising from the streets. And that essentially, as far as Iran is concerned, the war is ongoing until and unless all strikes and attacks stop, and they reserve the right to, formally attack." Sort of enemy ships, so to speak, in the Strait of Hormuz. So there we are. That's the state of play this morning. And what we can basically see here is that the oil market obviously had this incredible sort of spike and drop, and is now, but it has actually, if we let's say put this on a 4-hour chart, you can see here that since the low, which coincided to that a perfect sort of level there, by the way, 81.56, we can see that WTI has actually, it hasn't ripped much higher, but it's actually gone up another $8 or another 10%. So the point is that it's not as though it's come down to pre-war levels, which would be sort of in the late 60s or something. We're still trading compared to pre-war levels levels. Now, if we take pre-war levels, something around about down here, we can see that we're still up 33%, so still up a third, or about $22. So, the implications for the global economy of increased energy prices in terms of higher yields, they're still there. They have dissipated somewhat, and of course, if we get the Strategic Petroleum Reserve, if we have some sort of more formal announcement from Trump that victory declared, or even from the Iranian side, which I doubt, oil might sort of slip back down. But let's just keep in mind that it is 25-30% higher than where we were just a while ago. I do beg your pardon here, because I completely got the wrong date. Sorry, let me redo that. The start of the war was, of course, here, so we are at those levels, but we're still, there was a ramp up as the tensions ramped up. So yeah, let's just be very clear here. That's where the war started. Oil's going into that sort of Friday. No, hold on. Let me just, sorry. That's the 1 hour chart is, am I right here? There's the war. There's the war starting. Right. Okay. No, so it is a lot higher. Exactly. I was being confused by the 4 hour chart. Point being is that there's been some alleviation of pressure, but let's say, for example, the time spreads are still elevated, so they obviously came down. This is sort of April, December, but as you can see, they're still sort of pushing higher, and there's still an incredible premium between the prompt and let's say December of almost $20. So the market has not signaled the all clear. We still have gasoline prices have come down, but also still elevated. And talking about gasoline prices, in the US, on average, they've gone up about 50 cents per gallon. So now on an average of about $3.50 per gallon, which is elevated for the US. So you've got to think that Trump has one eye on the midterm elections and will certainly not welcome any extended period of high gasoline prices. So that's something to keep in mind. The other issue which we should keep an eye on here is the TTF contract, which is nat gas contract sort of in Europe. Now, obviously, it's not at these crazy elevated levels, but as you can see, again, just like sort of crude oil, if we look at the pre-war, which is, let's say, this sort of Thursday or Friday before, we're still up about 50%. So a 50% hike above, and that's basically causing even more pressure in Europe. So the inflationary pressure, and the pressure of energy shock is still higher in Europe, and we can see that if we look at the STIR market, so the short-term interest rates in terms of sort of central banking. So if we look at what's been happening to the SOFRs, which is the US ones, let's look at, let's say, December, and you can see here that we've had a massive run up in implied yields. At the highest, we're up about 33 basis points, and of course that's come back down. But again, you can see overnight climbing a little bit again. Okay, so the point is here is that the inflationary pressures and a potentially more hawkish central bank policy is definitely still part of the calculus for the US. But if we switch over to Europe and look at the Euribor, for the where are we? This is for the December. You can see that this has even gone more. So if we go up, you can see that went up to 63 basis points. That's 2.5 hikes. 2.5 hikes priced in. Now, of course, that's come down a lot over the last 24 hours. So if we now go to the last 24 hours, we still have 35 basis points. So point is here is that there is a sort of a differential here between the perceived shock in terms of inflation. Europe is still perceiving that to be a much higher shock, and in fact, the prices have affected Europe a lot more. So in terms of the ECB and central banking, it's going to be interesting also to see where we go with this pricing over the next few days, depending on political developments. But I want to have a look here at some of the FX. And you can see that, the euro yesterday, it bounced as obviously the dollar. Actually, let's have a look at the dollar. The dollar sold off a lot on the news along with oil. So it's very clear as well, just what's happening at the moment is that as oil goes up, the dollar rises and yields rise, and gold it comes under pressure, and equities become under pressure. As oil sells off, we have the equities bouncing, we have a small bounce in gold, and we have dollar weakness, and we have the yields coming down. So you can see here that really the function of the dollar at the moment and the euro and a lot of the other currencies is directly linked to oil. And we can see here that the key level here where we got to is about 99.6. That simply is going to be a function of the oil price. If we start getting if the hostilities continue and there's less rhetoric and oil infrastructure is attacked, and the Strait of Hormuz remains blocked. I can see the dollar retesting that. And in terms of the euro, we can also see the euro going back down to this pretty key level down at about 115. On the other hand, if everything sort of calms down and the Strait of Hormuz gets open, obviously that'll be a big positive, and we'll see the euro go up there. That's also going to be interesting, just in terms of some of the other currencies. What we've seen here is that the dollar again retreating in terms of USD JPY from 159, and it's a similar kind of situation as the euro, so I won't repeat that. What is interesting about Japan is that Japan, like Europe, is a net energy importer, but even more so. So very, very sensitive to the price of energy globally, and that simply is going to be a function of the oil price at the moment. What is interesting is that, as I said, CAD has remained relatively resilient, and even with the sort of the weakening of the dollar yesterday, CAD. The CAD didn't change too much. You can see that this is a positive environment overall for CAD in the sense that if the US dollar is strong because of oil prices, Canada obviously is an energy exporter, so that's positive. On the other hand, it will weaken a little bit if the US dollar weakens and energy prices go down a little bit. But, not huge moves at this point. What is interesting as well is the Australian dollar had a very big sort of rebound. And again, I was just waiting for that to happen because Australia is is a very big commodity exporter. It's an energy producer, especially of natural gas, more so than crude oil. And we have a hawkish RBA because of, strong inflation and a strong domestic economy. So the Australian dollar had been beaten down a little bit, not as much as other currencies because it was less exposed to these sort of global sort of energy shocks. And you can see here it's had a very, very strong rebound, probably the strongest rebound. And that was also because overnight we had a fairly strong, higher than expected, or better than expected sort of numbers from China in terms of their imports and exports, which were much higher than expected, and also slightly higher inflationary pressures. So basically all of that arguing for maybe an expanding Chinese economy, a strengthening Chinese economy, which of course is Australia's main export partner and trading partner, I should say, or export destination and trading partner. So the Aussie dollar doing pretty well, not only on the weakening oil prices and the general risk on tone, but also some domestic and sort of China-based metrics here. And it would not surprise me to see it test up towards a 71.30 level, at least in the short term. So in terms of some other markets here, just getting back to, let's have a look at equities. Volatility obviously has come down a lot. You can see here that there was yesterday a massive, massive spike in the VIX. That's come down a lot. So we're now at mid-20s, but that's still fairly sort of elevated. So we can expect more volatility both on the upside and the downside. All of the other volatility measures have come in. So if you're just looking at the US equities, we've seen globally a pretty strong bounce. Interesting here just to see what's going on with the US equities. This is still a weak chart. You can see it's a rounding kind of top. We've broken through some technical damage, the 100-day EMA, the 200-day EMA. We held, that's obviously now a very key level on the ES futures at 65.85. You can see that to the tick was supported yesterday, and we've subsequently had a pretty strong rebound. But if we look, let's say, like at a 4-hour chart here, just to have it a little bit more granular, without confusing myself as I just did with oil. But really, let's just see what the bulls have to do here. So far so good. I mean, we've had on the shorter term impulse down. You can see that we're above the 61.8 fib retracement, so that's quite bullish and looking good. But let's say if we go out to a slightly longer term fib, you can see that we've got through the 38, the 50, and we're getting up to pretty key levels. So I would say the first key level, which we actually sort of failed just sort of overnight, was that you see this fib level here at about 68.30. 68.30 is probably a more interesting sort of level here. That's the one which the bulls have to get through. If we retest that, and you can see we failed sometime overnight. If we retest that or can't retest that, or we retest it and rejects, that would signal that there could be a little bit more downside here. So let's watch that level. That's the key level for me today. It's going to be that 68.30 level this morning. And really the bulls need to break through that, and ideally then to push up towards the 68.98 level. That's really what needs to happen there for the bulls to take a bit more control. But so far so good. NASDAQ also recovering. A similar kind of situation there, the Russell. What is interesting is just to see, just in terms of some of these subcomponents, we've seen a pretty strong performance of the the software ETF IGV, which obviously bounced from a pretty key level. It was very oversold. In the pre-market looks pretty good. So that looks as though that has a little bit more room to run. Interesting, the semiconductors also had a big green candle. So bouncing off the 100-day EMA, that's looking pretty good. Generally, Mag 7s also. So overall, the sort of the not only the US, but the global equity also doing pretty well. And what will be interesting here, you can see that the US, this is the SPY divided by EFA, which is the Europe and sort of developed markets, farthest Asia. You can see here that the US had been underperforming significantly all through the beginning of 2026. But in this crisis, the US actually outperformed Europe. So it could be interesting to see if whether we go back to that old playbook of sort of the developed markets, so sort of China, sort of Japan and Europe, developed markets outperforming the US. We're starting to see that a little bit in the last 24 hours. Let's see if that continues. Apart from that, the Euro stocks, a big bounce off the 200-day EMA. We can also see over in Germany, the DAX having a huge bounce. So, sort of a risk-on tone is still in the markets this morning. If we look at the Nikkei, also having a little bit of green. If we look at Brazil, sort of starting to crawl its way back. So overall, quite a lot of positivity. If we look at the Kospi as well, sort of bouncing high. So, positivity in the Asian markets, in other developed markets and global equity in general. But as I say, the market hasn't fully recovered, and looking at the energy markets, still quite a delicate situation here. And really, what we're going to have to see is a cessation of hostilities, like a bit more of a formal declaration from Trump and maybe from Israel. And then, obviously, the big thing is going to be the the Strait of Hormuz reopening, and obviously sort of energy facilities getting back to full production capacity in like Qatar for nat gas, and the Saudis and the Iraqis and everyone. And we're not there yet. We're not there yet. And of course, let's see what happens with the Strategic Petroleum Reserve and maybe some other measures. So what I'm trying to say is that it's going to be quite an interesting session today, because we've had the easy part. We've had the easy reactive bounce. Yay, we had the good news, potentially good news. But as I say, Trump is a wild card. And yesterday, even at his press conference, he was more bellicose than his earlier reported comments. So the point is that any comment from Trump, an oil tanker being, sort of blown up in the Strait of Hormuz, anything like that will get the market's attention. The market is still very unstable and fragile, and the VIX is still elevated. So that's that. The other thing which I just want to have a quick look at is just a couple of other markets here. We have some data today. We have the ADP. That's expected, I think, at about plus 12,000. The ADP job report in the US, the weekly number, probably not going to be massively market moving. But what is going to be interesting, keep in mind that we had a very weak non-farm payrolls last Friday, which is sort of a bit lost in the mix of the whole Iran oil situation. But the non-farm payrolls was very weak last Friday. And if the ADP comes in substantially weaker than expectations, that could just refocus the market's attention on the fact that not only do we have this energy price shock and a potential sort of inflation shock, but we also potentially have a slowing US economy. And at that point, you start getting into the realm of people talking about stagflation and whatnot. So let's keep at least one eye open on the ADP this morning. Finally, just want to have a quick look at the metals. It is interesting with gold is just trading in a little range here, but I think that's actually quite productive. We have a slightly softer US dollar, and maybe if oil can calm down, and then the sort of hyperinflation fears can sort of dissipate somewhat. This is actually looking to be quite constructive for gold, because my humble opinion, the reasons for sort of diversification into a little bit more gold by global asset sort of allocators, I think those conditions are still there. And it seems to me that gold could, once the stability goes, gold could actually push a little bit higher here. I'm having a look at that today, and I think gold could push out higher. And we're already seeing, for example, silver starting to push a little bit higher as well. We're seeing copper, although supplies, sort of inventories at most of the global exchanges for copper are quite elevated, but copper also having a little bit of a risk on bounce today. So, but I think gold could be the one which it's still a very fragile geopolitical situation globally. We still have central bank, concerns perhaps in the US. We still have sort of in sticky inflation. We have maybe people wanting to diversify away a little bit from the US, a little bit from the US dollar at the margin. So I think that's all propitious for gold pushing a little bit higher. One thing I also want to keep an eye on here is BTC, the Bitcoin. Interesting price action, because if we look at it here, I was saying that the first hurdle was that 38% fib retracement, which basically failed at. So that wasn't great. But then I was saying that really that was okay. The bulls had to come in this sort of shorter term fib zones here. They failed at the 38 and the 50, but they seem to have sort of held it together just at the 68% here. So the bulls taking it here. So this is a pretty critical day or two, in my humble opinion, for BTC, because if we cannot re-achieve or re-reach this sort of 74,000 level, that would be a sort of a bit of a red flag, so to speak, and preferably break through. So really the bulls, the first goal here, they have to get back up to that recent high at about 74,000, 73, 74,000. If it fails there and comes back down, that I would say is a fairly negative excuse me, price action. But if they can get up to there, hold there, maybe even have a small retracement and then push higher, that's definitely a positive price action for BTC holders at this point. And as we see, we did retrace, but it was sort of a higher low. So again, positive basing formation. It looks as though it's going to be a sort of a process rather than a quick, sort of rip. But that's ultimately probably going to be healthier as well. Okay, guys, I'll leave it there today. Slowly getting better. I'll be back tomorrow with the macro snapshot. As I say today, obviously, let's keep an eye on the time spreads on oil, headlines, all kinds of stuff. ADP coming out, I think, at 8:15, if I'm not mistaken, as well, in about an hour and a quarter. Have a great day and take care. Thank you.